All right, folks, welcome to this month's episode of Navigating the Markets. We're seeing something that is rather unusual. Haven't seen it for about 30 years now. And that is international stocks are outperforming US stocks by the most that we've seen since 1995 as we start this year, which is pretty incredible stuff. I think that this trend is set to continue. It happened last year as well. It wasn't quite at this much of an outperformance gap, and that gap started to build as the year went on because of trade tensions and otherwise. But I think this is a trend that's set to continue. You can actually see emerging markets breaking out of multi-decade ranges to the upside as well. I think there's still a lot more upside to come in emerging markets. I think that's an area where if you're very US focused, you might want to start looking out around to some of the other parts of the world, because from what I can see, valuations are more attractive. There are some pretty solid growth prospects, and it's also a decent hedge if you're concerned about the dollar over the long term. Back here in the US, something that concerns me a little bit is one of the bigger support mechanisms for the market has been buybacks. Buybacks are incredibly important to keeping stocks moving higher. Not only do they make the earnings multiples look better because you're taking the float down, so you're making the PE look better, you're making earnings per share look better. So it's kind of a bit of financial engineering. In fact, for a while, buybacks were actually illegal. But on the other side of it, what are they being substituted with? It's CapEx for AI. And this is becoming a greater concern for this market. It's looking at this and saying, gee, is this sustainable? Where's the ROI for all of this money spent? And it's a fair question. It's a question that the market is having to reconsider as we see yet another quarter of earnings from the mega cap techs with upsized CapEx, both spending during that quarter and moving forward. And we can't be terribly surprised. We have a tax system right now with the so-called Big Beautiful Bill that incentivizes a lot of this spending because you can realize a full deduction the same year. So companies are basically being told by the government, hey, if you're going to spend on this, spend what you can because you can realize those tax benefits near term. So that's on the one hand. On the other hand, however, AI is changing. It's becoming much more efficient, whether you look at the hardware layer, how we're doing inference, or the models themselves with an increasing density of intelligence. And that starts to suggest that you're not going to win purely by scale. You're actually going to have to do engineering to build higher quality models. If the race was just about scale, XAI and Meta would have won already. It's not just about scale. It's about density of intelligence per parameter, which makes some of these new open weight models pretty exciting, like GLM5, Minimax M2.5, and the latest model that just dropped from Alibaba's Qwen, version 3.5. These are models that are a fraction of the size of the US frontier proprietary peers and are punching above their weight. They're not necessarily the same as Opus 4.5 or 4.6 or GPT 5.3, but they're getting closer and closer. That gap is narrowing. And we're talking about smaller models too. So density of intelligence, that's the new benchmark. That's the most important thing to look at. And that starts to call some of this CapEx in question because that's more a race of scale, which hasn't really served a lot of the heavy investors well. Outside of Google, I don't think a lot of the mega caps doing this aggressive CapEx are necessarily on the right path. Just my own 2 cents. And here's why. Because free cash flow is becoming increasingly compressed. And that is going to become something that concerns investors more and more should this trend continue. Now, on the other side of it, really curious, both with the relative resilience of Apple. Apple, one of the biggest companies in the world, cannot be bothered to spend much on AI. Now, say what you will about Siri and their autocorrect. We know they're garbage, so they haven't invested in that either. But there's maybe a reason that Apple is skipping some of this investment. My own 2 cents, AI is a force multiplier, generative AI, but it's not yet at a point where it's going to replace humans at scale. We heard Microsoft's head of AI saying, AI is going to replace all white-collar jobs in 18 months. I personally don't buy that. I think we're on a further time horizon. We need to make the next step of progress in this research to get there. But nevertheless, this is one reason Apple's been relatively resilient. Now, let's get into some technicals and momentum here, because these markets are starting to look pretty weak for the S&P and the NASDAQ. I don't like where the S&P is trading here too much. We really need to bounce very soon to get out of the way of breaking down from the bottom of this trading range. And we've had plenty of bounces back up to the top and then moves back down to the bottom. This has been a range that we've been trading basically for the last 2.5 months. Eventually, it is going to resolve. The longer it coils up, the bigger the ultimate resolution is for the directional move. That is to say, it's sort of like a spring. It's coiling up over time, and eventually that energy gets released. I'm starting to think that energy could be released to the downside here. If we do break the bottom of this range, particularly on a weekly closing basis, around 65.23 comes into play. That would be revisiting, or I should say 65.25 if we want to hit it right on the dot. That's the November low in this March contract. So that would be a level that if we do go back down and we see a nice retest and it validates that support, I'd be a buyer of swing longs right down there. I think at that point you've probably reset some of the excess long side speculation, and you have an opportunity to try to take a pretty good trade on a risk to reward basis. That is to say, you'll know you're wrong pretty quickly. So you could risk, say, 20 points for the potential to make 200 points. Those risk to reward ratios look pretty good to me. On the other side of it, NASDAQ also looking pretty weak here. It's a pretty similar chart as the S&P, but you could argue that this one has been in a trading range for really the better part of the last 4 months. And I think that the NASDAQ looks heavier than the S&P. It's never been able to reclaim that uptrend line from last year. I stopped putting it on the chart because it's almost at this point so far away it doesn't matter. So it's already kind of fragile in terms of the health of its momentum. And it's once again tempting the lower end of this range. Just like the S&P, I think if it closes below this trading range on a weekly basis, we're going back down to some prior lows. In the case of the NASDAQ, however, I think it would be revisiting the lows back from September, August. So that would take us down to about 23,000. It wouldn't be super surprising. It's not that far away. It's about a 5% decline. But that would also set up for an area where I would start considering nibbling on swing longs if we can get down to that level, bounce, show its support, and get some follow through. I'd start layering into swing longs, looking for a move back up of about 1,000 points. Then we have gold. Gold is actually looking pretty good. So we did have a mania in precious metals. There's no two ways about it. It didn't show up in commitment of traders because it wasn't professionals. It wasn't futures where this was being expressed. Largely, it's happening in the retail vehicles. So the GLD ETF, the SLV ETF especially, and their options. The mania that happened in gold was not anything even remotely approaching what we saw in silver. The sort of craziness that happened in silver was actually historic by nature. So for that reason and more, and we'll talk about silver on the next chart in a little more depth, but for gold, its uptrend is still intact. I'm still bullish of higher highs for gold, and it's sort of trading this channel. It's actually being pretty well behaved in this channel. We can see there was another reflection from the top of that range recently. I think gold could get to $6,000 an ounce by the latter half of this year, sometime in the second half. I wouldn't be too surprised. It's healthy to see it consolidate these gains. It's healthy to see it move sideways. I know there are folks that are just looking for up, up, and away. In the commodity space, when you see up, up, and away, it tends to end badly. That is to say, these parabolic moves, they tend to end with downside that's even faster than that sharp upside move. So with gold, we've got an uptrend that still looks good. With silver, it's hard to make that same argument. Silver broke below its uptrend from December, that steep ascent that took us all the way above $120 an ounce. And now it's actually looking pretty darn weak. I don't think that basically, if silver can't hold above $70 an ounce, I don't think there's any way it's going to get. It's I kind of bungled that. I'm going to say it much more clearly. If silver can't hold above $70 an ounce, I think it's going back to 60. I don't think there's going to be much support. There's kind of an air pocket down there. And, this big ascent that we had from December on did not build a lot of healthy market structure. The market structure that we have is right here at 70. Like, this is where the most chunky support exists. So if you're bullish on silver, you definitely want to see it hold here, but it is looking pretty heavy. Silver also tends to do poorly in February. The seasonality for the metal tends to be really rough. I think it only has upside about 20% of the time over the last 5 years. And this is something I posted in late January. I also shared with the Trader Aid members that actually during February, short silver and long gold might be the trade. And so far that seems to be working out relatively well. But I still do think over a longer time horizon, silver is going to get its momentum back to the upside, but it's going to take some time because we're doing that sort of cleansing process. We've shaken out a lot of the late longs. Now we're making silver boring enough that people don't really look at it quite as much. And then, when that attention shifts away and you start to see some of these upside catalysts rebuild, I think we are going to get back to the highs we've seen and even higher than that. I wouldn't be terribly surprised to see silver around $150 an ounce by the end of this year. But I do think we have this sort of consolidation phase that needs to continue. And it's good if it does, because as I've talked about, when you consolidate, you're building that coiled spring. The longer you're moving sideways and chopping the range, the more robust the directional resolution will ultimately be. So if we can hold 70 and sort of chop sideways for maybe a month or 2 or 3, when we ultimately resolve, and I think it will be to the upside, you're likely to have a very powerful move. So that's what I'm looking for with silver. More sideways consolidation unless we break 70, in which case 60 and even lower could happen pretty quickly. Bitcoin looks terrible. I can't say anything other than that, really, based on what I've seen with the charts on multiple time frames. I would not be terribly surprised to see Bitcoin down around 52,787. Right now, we're in a high volume node. We're kind of pinned to an area where there's been a lot of interest in transacting. The slip that we had was through a low volume node. So this big fast decline that happened, we just ripped through a low volume node. There wasn't a lot of defense. Now we're back in a high volume node that will probably hold for a little bit. You'll likely see some consolidation, and then I think we move lower. And really, the primary thesis here is very simple for me. Bitcoin is a relief valve for excess speculative liquidity. It trades like that. When there's abundance of liquidity, it's bid. When liquidity is scarce, it declines. Liquidity remains scarce. Bitcoin is declining and likely to continue declining. And so I think that's something we have to keep an eye on. Things like reverse repos, bank reserves, monetary fiscal policy, all of that can create some excess speculative liquidity needs to come back online for Bitcoin to get a more robust bid. So for now, I still think the path of least resistance is lower unless we can make a weekly break above that 72,255 level. Then there's our friend, the US dollar, which we hear all the time it's going to die, it's going to zero, no one wants to use the dollar anymore. I will say I take a much more middle of the road approach on this. On the one hand, de-dollarization is accelerating. There's no doubt about it. We've seen that trend accelerate since 2022 when the dollar was used as a weapon against Russia, Iran, and others. More central banks started to buy gold. More investors started diversifying away from U.S. assets. And that's only continued to intensify under Trump with all these trade tensions and all the sort of shaking up of the world order. On the other hand, however, this is a very formidable trend line. So to want to see the dollar break here, it could take some time. It may not break anytime soon. In fact, dollar short positioning across multiple metrics is very blown out. So the dollar hate trade has become the consensus trade. It's one reason metals had such a run, but also why they became crowded. And like when everyone gets on one side of a boat, it can kind of topple over. That's what happened in metals. We had the opposite happening in the dollar. Everyone's crowded on the short side. We might get a bid here. And so that's something you have to take into consideration if you're bullish of things that are denominated in dollars, like commodities, like Bitcoin, etc., that you may actually see a period of time where the dollar gets bid. These things see more pressure to consolidate or correct until this trend breaks. And this is a monthly chart. This is a trend that goes back to 2008. Something that has been in place for that long is going to take a lot more testing before it ultimately succumbs. So I think that's something we also have to keep an eye on. And remember, the dollar index is mostly euro, pound sterling, Japanese yen. These are countries with their own problems, their own policy issues. So, the fact that the dollar could get bid here as those other currencies skid is not that unlikely of a scenario. Looking at CTAs as a proxy for all this dollar hatred, and this is showing up in multiple charts. It's not just the CTAs. In fact, CTAs are a relatively small part of the foreign exchange market, but when you look at all of the different aggregates of data, it's a very crowded short trade in the dollar. And that's why I think we have to be a little cautious with precious metals and their miners, and a little bit cautious with some of the other things that are, basically on the opposite side of the dollar. For now, I don't think this is a long-term trend. I still think that all the things that have eroded the dollar as a currency of choice for more and more trade settlement are going to continue. But it's a slow bleed. This is not something that's going to happen overnight. There's over $100 trillion worth of debt that's priced in dollars, for example, which creates recurrent demand for the dollar as it's being paid back. And there's still trades that are settled in the dollar, albeit less over time. That also creates recurrent demand for dollar and dollar denominated assets. So it's not going to happen with the snap of a finger. It's much more of a slow unwind over time. Now let's talk a little bit about these weekly pivots here. We're below it for the S&P, for the NASDAQ, for gold, and for silver. So all of these pivots are giving us a sense that right now it's a bit of a risk-off time. It's a good time to be more careful about how we're managing our positions, because this is a market that is becoming less and less forgiving, especially for the crowded parts of it. All right, so let's talk a little bit about options as well. I've seen a lot of charts going out around the S&P and the broader index options showing some extremes in put buying. And while those charts are cool to look at, I find a lot more value in my own process looking at the CBOE equity put-call ratio. So instead of looking at index options where there's all kinds of hedging going on, I find the equity put-call ratio to be more helpful because it's really much more about sentiment. So right now, we're in the neutral zone. While the index options put-call ratio aggregates are showing extremes, where put-call ratio is over 1, this is showing us more in the neutral zone. So there's not that palpable fear in individual stock options. That tells us that we're not as close to a bottom driven by extremes as maybe some of the other charts might have suggested, which is good to calibrate our risk management. We should be looking for the potential further downside if we break below these trading ranges. And another way of looking at this is the variance between skew in the NASDAQ index and single stocks. NASDAQ index skew is back to highs we haven't seen since early 2025. So those are the more sophisticated hedging strategies coming online. Those are larger institutions trying to protect their book, or maybe even levering up a little bit into this weakness by using those puts to decrease their value at risk ratio. But on the other side, single stock skew pretty low. Not a lot of nervousness in the single stocks yet, despite the fact that software as a service has had its worst 6-month rolling returns ever, worse than the dot-com bust. Still not a lot of nervousness out there. We'll see if that changes. Now with the S&P 500, we've got a pretty sizable put wall down here at 6,800. That's right down there at the lower end of that trading range as well. So you have confluence, the lower end of the trading range, and that put wall at 6,800, just around the same level. So that tells us we should see some support right around here. But if we do break, we can have an accelerated journey to the downside. So again, looking at this trading range in the S&P and the NASDAQ and really looking for that bottom to hold if you want a bullish resolution. But these are looking heavier and heavier. It is becoming more likely that we could have some continuation of downside. We're also in negative gamma territory, which typically feeds on itself. That is an environment where dealer hedging patterns change a bit. So you see dealers more likely to sell dips and buy rips, which is a volatility catalyst, essentially. And here are our S&P options levels. These are for the index. So you're welcome to take a screenshot of these. This is from the SPX options visualizer. And one thing about this, I know that folks are getting a little nervous. You know, there's a pretty nasty market out there overall. You know, outside of some of the sectors that have done really well, energy, for example, some of the defensive stocks, there is some pain, especially seeing that happen in the more crowded parts of the market, growth in tech and precious metals. So I get it. But this is simply a phase. You've got to make a shopping list. You've got to have dry powder and be ready for when the selling is over to take advantage of some of these discounts.